75 basis point hike from the Federal Reserve, their entire talk track, all their talking points. A recession is not here. We do not see a recession. We do not believe the United States economy is in a recession. First, why are they raising interest rates at 75 basis points and being so aggressive if the last one didn't work?
Well, give the guys some credit. Their monetary policy, at least according to them, and I would tend to agree with this, takes time to filter through the economy. It doesn't impact everyone because there's a lot of debt that's not on floating rate basis. There's a lot of debt that's obviously on fixed rate, including most mortgages. So it takes time for incremental consumers and incremental sort of people who are tapping debt markets to really feel the impact of that. So ultimately, what the policy choices that they're making today are intended to have an impact on the economy. Let's call it the general consensus on this is somewhere between 2 to 3 to 4 quarters down the road.
As we look at 75 basis points, 50 was kind of the general thought process a couple of months ago. Then they jacked up to 75. Could they go to 100? Do you think 75 is kind of the upper bound of what is possible?
Yeah, in fact, I mean, it's probably the last 75 basis point hike we're likely to get. If you think about so 100 basis points was that was shot for dead really quickly. On the other side of that inflation report, we sent out, or not we, the FOMC sent out Bullard and Waller to sort of tap that down. But as it relates to, the continuation of 75 basis points, we're probably going to have to see inflation pressure continue to build from here. Now, it's not necessarily likely to continue to build, particularly on the headline side, because we have seen a pretty significant decline in energy and agricultural prices that should start to feed through into headline CPI. We do, however, see core CPI pressures continue to build. This is something we talked about last on the show with the new acceleration to an all-time high median CPI on a 3-month annualized basis. Sticky CPI accelerated to 40-year high in terms of on a 3-month annualized basis as well. So we are seeing a kind of a new push higher in core inflation, but it might be overwhelmed by declining food and energy prices as it relates to headline.
As we begin to look at some of those inflation measurements, they continue to talk about 9.1%. A couple of weeks ago, you and I were talking, and you were talking about the acceleration of kind of the 3-month annualized inflation. Do you think that that plays into kind of their continued aggressiveness, even though they only talk about Europe?
This is the problem, right? Like, we all know that inflation should eventually come down on a year-over-year rate of change basis just due to base effects. We don't need to unpack base effects here. It's probably not the right audience, but the problem with, kind of anchoring on base effects to get inflation down, which I think a lot of investors are making this mistake, which is if you only rely on base effects to get inflation down, you're going to wind up with a structurally higher kind of a base level of inflation by the end of that process. And so it's my belief, and I think, just based on the kind of the tea leaves we continue to hear out of Fed heads and obviously out of Powell yesterday, is that the momentum, the sequential change in inflation is really what's driving the boat from a policy standpoint. And the most recent data points we were getting, if you look at on a 3-month annualized rate of change basis, like pretty much everything in the entire inflation basket is accelerating to the upside, with the exception of energy. So, I mean, that's an issue for the Fed and an issue for markets, quite frankly, because it means, that inflation is likely to continue being a problem for longer than the sort of, the growth dynamics in the economy would appreciate.
Let's talk about the labor market. I know you've got this chart here that shows the labor market is too strong for the Fed to stop tightening. That seems to be one of two things they continue to point to. Even though GDP growth is negative now for 2 consecutive quarters, they say, hey, employment looks strong and consumer spending still looks pretty healthy. What's going on in the labor market?
Yeah, great question, man. So the reason I sent you a bunch of charts, most of them revolve around the labor market. The reason I sent those charts is because we can unpack all of them. The Fed is now shifting its sort of focus back in the direction of its dual mandate. Obviously it has the price stability mandate, but it also has the maximum employment mandate. So yesterday it gave the investors sort of tipped its cap and nodded to investors who are increasingly concerned about growth and the possibility of what we call a hashtag actual recession, which is different than the technical recession that was reported today. So going back to the labor market, the strength of the labor market, Powell effectively said very clearly and cogently, hey, look, the labor market is too strong for us, anyone to be worried about recession right now. And so this is putting up that chart, Pomp. Slide 82 from our macro scouting report just shows, kind of 3 main indicators that I think the Fed is anchoring on to give them confidence that the labor market is really strong. So the first the plot in the upper panel just shows the ratio between total job openings and total unemployed people. And at 1.9x, which is where we are today with the red dotted line, we're more than double the sort of the pre-COVID trend of 0.9, which is the blue dotted line in that chart. The middle panel shows the private sector quits rate. So this is the percentage of people who have jobs that are quitting in any given month. And obviously, when you quit your job, it's usually to go find a better job or a higher paying job, et cetera, like that. So it's an indication of how tight the labor market is. That number is at 3.1% coming off an all-time high last fall, and that's much higher than the pre-COVID trend of 2.4. And then lastly, the bottom panel, we show the employment cost index, which is the broadest measure of wages, of broadest measure of sort of wages in the economy. And that number at 4.5% is effectively a double of the 2.5% pre-COVID trend. So when the Fed looks at these statistics, it's seeing a labor market that is way too hot to stop tightening. If they're going to, if they're looking at growth as a sort of indicator that they can slow down on tightening and anchoring that segment of growth indicators on the labor market is not going to give them any signals anytime soon.
As you think about this labor market, how do you measure? We're seeing at least headlines, layoffs, hiring freezes. Like, I kind of think of it as there's a wall and there's cracks in the wall now. And sure, the dam hasn't bust yet. We're not at 4.5%, 5% unemployment or anything like that. But it does feel like we're kind of starting to see the cracks. We're seeing it tick up just a little bit. Is that something that you worry about? Or do you think that we'll have such a kind of multi-month headway or runway to actually see that market changing, and it'll give them enough time to kind of change their mind, because it won't happen overnight where we just go from 3.6 to 4.5% unemployment?
Yeah, so to be clear, it could happen overnight. It's just very unlikely to happen overnight. And the reason I say that is that we have not seen a significant enough decline in sort of aggregate income, consumer spending, and sort of non-residential fixed investment, business investment, to really kind of get you kind of concerned about a jump condition lower in the total employment and in the jobs market. The reality is, going back to the headlines we're seeing, we certainly are starting to see cracks in the dam. I mean, you can start to piece together all these different companies telling you that, hey, we're laying off, 10,000 people or 10% of our workforce, or we're freezing hiring, and all that stuff's going to get worse and worse and worse on an extended period of time, because again, the labor market is lagging with respect to the economic cycle, with respect to the market cycle. When you look at the labor market, and we're going back to some of these headlines, right? The headlines make the news, right? The headlines are what gets you to click on the article, but no one's going to put out a headline that says company XYZ is increasing hiring by 10,000, or company ABC is actually increasing its workforce by 10%. But that's actually what's been happening. If you go to slide 83, that next chart, Pomp, where we show, I think we talked about this chart after the jobs report a few weeks ago, but it's important to sort of reiterate for those who missed that show, which is the labor market is overheating by double. I mean, we kind of alluded to that in the previous chart, but this next chart, slide 83, where we show private payrolls growth, that's the first cluster of bars. The light blue bars, the pre-COVID trend, the 5-year trend through 2019. The dark blue bars, the most recent month. June is the most recent jobs report we have. And so at 3.4% in private payrolls growth on a 3-month annualized basis, that's literally more than double than where we, what we saw in the pre-COVID trend. Average hourly earnings, that second cluster of bars, 5.8%, basically double the pre-COVID trend as well. And then lastly, the last cluster of bars, we show aggregate labor income, growing at 8%, I mean, versus a pre-COVID trend of 4.4%. I mean, it's telling you that, the media are doing a very poor job of actually reporting the labor market from a balanced perspective. The reality is the labor market continues. And again, because it's a lagging indicator, it's lagging all the growth that we had last year. It's lagging the all-time highs we saw in January. The reason those things continue to be very robust is because, again, it's a lagging indicator.